welcome everyone to another YCharts webinar looking at Q2 2023 economic data with our quarterly economic update. My name is Joe Clevin. I'm a senior analyst here at YCharts, and I am joined by my colleague, customer success manager, and good friend, Mr. Tom Joyce. Tom, how are you doing today, sir?
Joe, I'm good. Thanks for having me on. Looking forward to chatting through the second quarter of the economy.
Absolutely. Well, I'm glad to have you here, Tom, by my side. And as we do every quarter, today we are reviewing our latest economic update deck with visuals and data summarizing Q2 of 2023. And our hope is that this data can help you navigate whatever is in store for the rest of the year. We're already halfway through 2023. Crazy to think about that. Let's see what we've got potentially on the docket for the second half of the year. And as I said, this is a slide deck that we at YCharts publish for our clients every quarter. And clients can access the deck by logging into YCharts, which I'll show here real quick, and just heading down to support topics, clicking on resources, and then over here on the left-hand side, just hitting that economic summary deck and downloading Q2 2023s. That'll put a PowerPoint file right on your desktop that has the deck and all the charts, which can be copied and cut from the deck and put into your own communications with clients. So definitely check it out if you are a YCharts Pro user. And if you're not, consider the Pro tier and also take a look at starting a 7-day free trial where we don't require a credit card if you haven't done so already. One new feature I'd like to highlight real quick, and then we'll jump into things, is in our new report builder tool, we now have the economic summary deck as a report builder template. So if you just hit create new and the new from YCharts template, scroll down to presentation, and by clicking the quarterly economic update slide deck here, the economic summary deck will actually load into our report builder tool where you can add your own charts, customize with your own logo and colors, like so, by pulling in your own fundamental charts if you'd like to add something different, etc. And everything from the economic summary deck is included in this template, all at the click of a button. And from here, you can save it to your account, share it with team members, and actually generate your own PDF report right from Report Builder here. So it's a great way to get the economic summary deck out of PowerPoint and into YCharts to then customize it with whatever your heart desires or your clients' hearts desire for added communication there. And so just a couple last things, and then we'll go ahead and get started here. Just please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Nearly all the data we're reviewing today was published by different government agencies and private agencies in mid-April, and data is as of the end of Q2, which is June 30th, 2023. Last but not least, I promise, we will be emailing a recording of today's webinar and a copy of the deck to all attendees. So you can expect that in your inbox tomorrow. And this will also be available as a replay on our YouTube channel for added access. So remember to like and subscribe to the YCharts channel so you don't miss out on any of our newly released videos and all of our great webinars. That is it for me to start, and I will, Tom, pass it off to you to get us started. Take us away.
Perfect. Thanks, Joe. Much appreciated. So first, we'll go ahead and take a look at some market data. So we'll take a look at the broader based market indices. As we can see here, U.S. markets were up in Q2 with the NASDAQ setting the pace here once again with a return of just over 13%. But the other indices definitely joined the party. S&P 500 up 8.74%, and the Dow Jones up nearly 4%. The global markets also had a good quarter in return, 3.3% for the EFA, 3.22% for the MSCI World Index ex-US, and then 1.04% for the MSCI. So US markets definitely setting the pace here, but global markets seeing an uptick as well. On to US stock sector performance. So we had 8 of 11 sectors were positive in Q2. We had 3 double-digit gainers: the tech sector, communication services, and consumer discretionary. While we had 3 laggards in the red: energy, utilities down 2.54%, which was the largest laggard, and then consumer staples was just narrowly negative on the quarter.
All right, pretty solid performance all around there. Thanks you, Tom. And then continuing this with our asset class heat map, this table shows the performance of key asset classes over different time frames. And the 1, 3, 5, and 10-year columns are showing annualized performance there over those time frames. US growth and the S&P 500 continue to be top performers, with US growth up 12.8%, the S&P 500 up 8.7%, small caps there at 5.2% as well. All 3 bond asset classes, that being muni bonds, aggregate bonds, and US treasuries, were all down in the quarter, and commodities was bringing up the rear, down minus 2.7%. Adding to some poor performance in the 6-month and 1-year timeframes as well. In terms of 6-month as well, as you can see on the year, commodities also in the caboose down 7.5%, as 6 months does equal year to date as well. But US growth and S&P 500 really charging things higher, as we saw on the last couple slides. And this is a similar heat map here showing asset class performance, but on a quarter by quarter basis. So we do see that US growth really has been the leader this year in both Q1 and Q2. The S&P 500 hasn't fallen off the podium, finishing 3rd in the first quarter and 2nd in Q2. And like I mentioned on the last slide, commodities definitely the laggard here in 2023 after topping the list in 2 of the quarters last year in 2022. So certainly a fall from grace there from commodities, but we do have a whole half of the year left. So we will see what is in store for the rest of the year.
Yeah, super interesting data there. Thank you, Joe. Now shifting into a more custom look here. So we've aggregated some diversified portfolios, and you can see the allocations located on the right-hand side of the screen. So for example, we've taken a look at an all-stock index with the S&P 500, and then we've taken a look at an 80-20 aggressive portfolio, a 50-50 balanced portfolio, and then a 20-80 conservative portfolio. So we've taken a look at this exercise before, for those of you that have joined us in the past. But taking a look at how it's performed over the trailing 12 months, the top chart is going to show us that the S&P 500 is outpacing all of these portfolios over the last 12 months, but all of the portfolios are also positive. So we're firmly positive on all three of these custom portfolios, as well as the broad equity index. Now below, we'll be taking a look at drawdowns. So what this is showing us here is in light purple, we'll be taking a look at the S&P 500. And then in dark green is the 20-80 conservative portfolio, which shows us that towards the end of 2022, we still had a drawdown. Of course, bonds were going through an interesting phase during that time frame, but it had the smallest drawdown in comparison to the equity index. Now the S&P 500 has entirely erased that drawdown. You can see it's hanging here at 0%. And then the other portfolios are seeing nearly erasing that drawdown that we've experienced back in 2022. So what we're seeing here, a very interesting synthesis here is to be able to say, look at the diversification qualities of these portfolios. Here's what they can do. That's an interesting conversation that you can have, an advisor can have with their end client. All right, now on to bonds and interest rates. So we've just got a slide here that's going to talk through the interest rate summary. And so on the left-hand side, we've got a data table, which is going to show us where these yields and rates sat at the end of each quarter. So you can see in the 6/30/2023 column, there are only 2 red arrows and the rest are green, which means that those rate increases tend to show through here. So the only rates that we didn't see, or yields that we didn't see have a sharp increase in the second quarter of 2023 was the B and the triple C high yields. Now, on the right-hand side, you can see the yield curve, which is going to show us that we're still seeing inversion, but past that point of inversion, we're seeing that yield curve flatten out. The 1 year, and we can see this from the table, the 1 year in the 630 column ended at 5.4%, whereas the 10-year ended at 3.81, and the 30-year ended at 3.85. So the 10, even the 10-2 spread is finishing at negative 1.06%, which is the second lowest it's been in quite some time. So something to keep an eye on as well.
Yes, indeed. So we'll actually touch on a bit more here in our macroeconomic data section, where we're going to look at a heat map of leading indicator data and trends. So this heat map is of various economic data points that are considered leading indicators and show their trends over time. The first 4 columns there on the left show a quarter by quarter change, whereas the following 12 columns show annual changes in this data. So here looking at the near term, the 10-2 yield spread that you just mentioned, Tom, it inverted further, but not only did it invert further, it actually retested its low from Q1, which was at minus 1.07%, which is a level that it hadn't previously fallen to in over 40 years. Now, on the other hand, consumer sentiment rose by 2.2 points, though year-over-year retail sales fell 0.5%. The Philly Fed Manufacturing Activity Index and NY Fed's current business activity both improved in Q2, but they are still firmly negative so far. And building permits and housing starts both slipped in Q2. We do have quite a mixed economic picture here, and a lot of eyes certainly, Tom, are on that yield spread like you mentioned on the previous slide. So we definitely will be seeing if there's any recession fears growing and if there even is one on the horizon. And then pivoting here over to US trade balance, we see here that on the left, we've got a chart of total exports versus imports, and then the trade balance, the chart on the right in yellow, which is essentially the spread between exports and imports. The table below shows how imports and exports have increased in all regions, except for China imports, which slumped 21% year over year. And we touched on a similar topic of a similar occurrence that happened last quarter as well. Overall, exports increased the most, however, in the European Union, which was by 15.5%. And goods exports specifically increased 17% within the EU, while services exports increased 32% in Canada, our neighbors to the north. Overall imports increased the most in Canada, and goods imports increased 13% in both Canada and the EU, while services imports increased by 25% to our neighbors to the south in Mexico. So overall, certainly some positive import-export data when it comes to the US and key trade partners.
All righty. Now, shifting into looking at the housing market, always a fun topic. So we've been seeing, obviously, an increase in the 30-year mortgage rate. It's top 7% last year. We've settled around 6.71 to end Q2. And of course, that elevated mortgage rate is going to affect some of the other slides some of the other lines on the chart on the left-hand side. And that includes mortgage originations and refinancing. So we've seen a decline in that on both sides, and we're continuing to see that decline. Can expect much of the same as long as that 30-year mortgage rate remains elevated. Now, the flip side of that coin is on the right-hand side, housing sentiment and other components. So that's coming from the National Association of Home Builders and Wells Fargo, some of these indices here. So we can see on the right-hand side, prospective buyers, housing market index, other sentiments. We're seeing those bounce off the low from Q1, and we're starting to see some respite from that. So hopefully we'll be able to see that continued trend in the right direction. And then in the data table below, we've got certain economic indicators. Of course, we're seeing a decline in housing starts and building permits, but we are seeing an increase in the National Home Price Index. So we're seeing increases in that over the 1 month and the 3 month. Still seeing a decline over the last year, but the short-term trend is promising. And then on to US dollar strength. So towards the top chart here, we've got the US CPI in red. We've got the US dollar index in green. And then we've got CPI purchasing power in blue. And this is over the trailing 3-year period. So we're seeing the purchasing power of the US dollar has decreased over 15% over the last 3 years due to those high inflationary pressures that we're experiencing. But you do have these 2 charts at the bottom, which is going to show you US dollar to euro exchange rate, British pound exchange rate. On the right-hand side, you've got the yuan and the yen. So on the left-hand side, we are seeing that the US dollar to euro exchange rate is continuing to decline. So it's almost looking to retest those lows that we've experienced recently. Same idea with the British pound. So retesting both of those lows, even reaching that low for the British pound or the US dollar to British pound exchange rate in Q2. On the right-hand side, we're almost seeing the exact opposite. We are retesting those 52-week highs when it comes to the US dollar to Chinese yuan exchange rate, as well as the US dollar to Japanese yen exchange rate.
All interesting points there, Tom. And it's funny you mentioned if you had taken a European vacation last year, that was certainly the time to do it with those exchange rates. Now that ship is a little bit sailed for the American dollar. On the other hand, with Japan and China now opening back up to the world, if you happen to go to Europe last year, today or this year rather might be the year to cross off Asia off of your travel list with those exchange rates and definitely get the best of both worlds there. And living in the moment, speaking of which, it's time to move on to our last segment here, and oftentimes our most crowd-pleasing one, that which is our charts of the moment. And we have 5 visuals here that depict trends most impacting the markets and investments. So first off, revisiting an often visited topic by advisors and definitely investors alike is that 10-2 spread retesting its deepest inversion in over 4 decades. On the left-hand chart here is the 10-2 spread compared to the S&P 500 going back to 1977, where we can definitely see around that 1980 mark, 1+% of a negative inversion being retested there. In the gray lines is US recessions, and as we do see that a 10-2 spread has preceded every US recession, with the exception of that brief one we had 3 years ago in 2020. On the right-hand chart here, we do have a more near-term look of the 10-2 spread. Here we're showing that spread versus the S&P 500 from 2022 through Q2 2023's end. So the last 18 months of data here, and you can definitely see with our low annotation right there how it has retested that inverted low. And one interesting point about this chart that I want to go and highlight real quick is that you can actually build this really easily within YCharts. And in fact, you don't even have to click all that many buttons here because we have it saved as one of our pre-built templates. So if you just go to new from template here at the top, and then click on economic data, the very first template we have is that 10-2 spread versus S&P 500. And with one single click, that chart is automatically on your screen just like that. And if you want to edit the date range to have a little bit more of a near-term view, you can just simply type in the preferred date range. And just like that, you now have an image that is ready to be exported to PNG format, or even shared directly to your Twitter account if you are a thought leader or just like getting on Twitter a lot. So definitely check it out if you haven't. Our pre-built templates are certainly a fan favorite. Now back to the show here. So moving on, further looking at the recession probability, looking to the yield curve and what kind of indication it might give us about a recession in the near future. We see here that the yield curve, like Tom had mentioned before, is quite inverted. The 6-month is currently paying 5.52% as of the end of Q3 2022. And we do see at the bottom that the 10-year is only paying out 3.81%. Now, that doesn't make a whole lot of sense, does it? Well, one thing that it does make sense is that that kind of inverted yield curve would lift the probability of a recession. We see here the Estrella and Michigan indicator, which is very yield curve based, has the US recession probability at 67.31% for 1 year out. That's June 30th of 2024. And on the chart to the right, we see that this is the third highest level of recession probability since 1960. Now, we had heard a lot of a talk about there potentially being a recession, and we do see that around 2020, after that brief recession occurred, the probability was quite increased there. But that looks to be around about a 35-40% mark. We're well over 67% now, according to Estrella and Michigan probability. So all eyes will certainly be looking at this earnings season and upcoming economic data to see if that recession that everyone's been talking about will actually kick in.
Yeah, definitely don't like those numbers, Joe. But to those of our viewers on the call, Joe mentioned it. The new firm template features are fantastic. You could even create charts like this, but always feel free to reach out to your sales and support rep in that capacity. We are more than happy to help assist. Staying in line with current events, just a quick inflation checkup. We're seeing some positive signs here. As we can see, CPI inflation rate has settled as of June, at the end of June, that is 2.97%. So we're below 3% on a year-over-year basis for the first time since early 2021. So good things ahead, hopefully. And then the producer price index year-over-year is finishing at 0.13%. And we haven't been that low since mid-2020. So as you can see, that arch continues to decline. We'll see how that goes. Towards the bottom, we've got the consumer price index value as well as the producer price index value, but certainly seeing some positive trends when it comes to inflation. And then we'll take a look at the state of the labor market here. So at the top, we've got US job openings, total non-farm, and then US unemployment rate in orange. So the big kind of emphasis post-pandemic was we've got 10 million plus job openings. Well, we're almost there. Still, we're at 9.8. So there are jobs to be filled, and we're flirting with record lows in terms of unemployment. 3.4% is the low. We're currently sitting at 3.6%. And at the bottom, you can see the labor force participation rate. So since that's the end of 2000, beginning of 01, we've seen a steady decline in terms of the labor force participation rate, and that hasn't really recovered. Even with the pandemic, we can see that drastic drop. It did come back, but not to the levels since pre-pandemic or since the early 2000s, late 90s. Something to focus on moving forward. Excellent. And I think we're coming down to potentially our last slide, if not one of our last slides, Joe. But lastly, we'll take a look at hourly earnings. Are workers actually getting ahead? Very, very interesting charts here upon further review. So on the left-hand side, we've got the US average hourly earnings, and that's the purple line in the top left. And then below that, you have a similar data point, US real average hourly earnings. So that's adjusted for inflation. You can see it's a little bit more volatile than the line at the top. And I think it tells a stronger story on the right-hand side, looking at those average hourly earnings year over year in the top right-hand corner. So we're seeing that 4.35% increase, but then we're seeing that on an inflation-adjusted basis in the top right-hand corner. Again, speaking to that volatility and how all the earnings are adjusted for inflation, we're just getting back to seeing a positive return in terms of hourly earnings adjusted for inflation, just the last 2 months on a year-over-year basis. So inflation obviously taking a hack at the wallets.
Great points all around, Tom. And just to note that real figure is only matching it's about February 2020 levels. So a little bit more lag than 3 years in terms of gains for re-average hourly earnings. And I want to go back into YCharts one last time to actually show how to create this chart, as it's been popularly requested throughout the webinar here in our chat feature. So just head into another fundamental chart real quick. All we need to do here is just like a Google search, just look for US average hourly earnings year over year. And then we can also take that real year over year figure and pop that on as well. To get them in their own panel, just click panel per security right here. That date, we can edit that back to 3/31/2007 to match the chart. And then a couple little bells and whistles features here is just by hitting annotate up at the top left and clicking the settings gear. You can then change it to any color that you prefer, or if you use our custom colors feature, your firm's or preset own colors and your logo will be populated the chart automatically. But you can also set an area chart to have this little emphasis right here and do the same for any other indicators you'd like to as well, to set that to blue and an area chart. And that really is how easy it is to recreate that chart and then just export it as an image or share it directly to your Twitter with your team. So super all around. You're right, Tom. That does take us to the end of our time here. Thank you all so much for joining us on our Q2 2023 economic update. We really hoped you enjoyed the information that we provided along with the charts to help paint some of those stories. And just as a reminder, this will be sent out via email as a replay, and you can also find that replay on our YouTube channel under @YCharts. And don't forget, we will include a free version of this deck. Pro users, if you log into your YCharts account, please go ahead and under support topics and resources and download that deck today. And check out our report builder tool that we highlighted in the beginning as well, so you can make a truly customized report and any kind of client communication you'd like to your standards for your clients. Thank you again, Tom, for hosting. We hope to see you again soon. And thank you all for joining. We hope to see you all soon as well. Take care now.